Most people think buying at an all time high is a mistake, but the world's most powerful central banks are doing exactly the opposite right now. As of July 22nd, 2026, gold has moved past the $4,100 mark, and these institutions are increasing their holdings rather than selling for a profit. You might wonder why the smartest money in the room is buying when the price is the most expensive it has ever been. The answer lies in a fundamental shift in how nations view security and sovereignty in a digital age. Today, we are going to look at the institutional blueprint that treats record prices as a signal to buy rather than a reason to wait. This starts with understanding a specific paradox that changes everything we know about investing. Retail investors are often taught to buy low and sell high, which makes a record breaking price feel like a danger zone. When the price of gold reaches new heights, the average person usually waits for a significant drop before they feel comfortable entering the market. However, central banks operate on a completely different timeline and set of priorities. To these institutions, a rising gold price is not just a number on a screen or a speculative trend to be timed. Instead, they view gold as a thermometer for the entire financial system. When the price hits an all time high, it signals to central banks that the underlying fiat currencies are losing their fundamental value. They do not see a high price as gold becoming expensive, but rather as the currency becoming cheaper and less reliable. Waiting for a price dip in this environment is seen as a massive risk because the currency could devalue faster than the price of gold corrects. If an institution waits for a 10% drop while the system faces structural instability, they might miss the chance to secure their wealth entirely. This shift in perspective transforms gold from a trading vehicle into a tool for systemic survival. By buying at the top, central banks are effectively placing a bet against the long term stability of paper assets. This behavior creates a unique phenomenon in the market that most individual investors completely overlook. But to understand how this keeps the price from falling back down, we have to look at where the big players are actually placing their orders. Before we keep going, if you're serious about protecting your savings with real assets, grab your free Gold IRA guide linked below. It explains exactly how to diversify part of your retirement into physical gold safely with no setup fees for up to 10 years. You'll find the link right below this video. Just click it, request your free guide, and see why so many investors are moving away from paper wealth and back to something real, gold. Now, let's keep going. When gold recently bounced back from the $4,000 level, it revealed what professional traders call a structural floor. This is a price point where massive sovereign entities have placed standing orders to buy every available ounce of metal. These institutions are not looking for a quick profit, but are instead trying to move large amounts of capital into a safe harbor. When these orders are filled, it creates a situation where the metal is effectively sold out to the general public at that price. This floor is not static and tends to move higher over time as the global money supply continues to expand. Every time more currency is printed, the baseline price for hard assets must reset to reflect the new reality of the market. This is why a price that seemed expensive a few years ago now looks like an impossible bargain that we may never see again. The speed at which gold recovers from a small dip is the clearest signal that these institutions are aggressively defending their positions. If the price recovers within hours or days of a small decline, it shows that the demand from central banks is far greater than the available supply. They are essentially building a foundation that prevents the price from returning to previous lows. This institutional support is driven by a need for something much deeper than just financial gain. It leads us to a principle of ownership that becomes vital when the world becomes increasingly divided and unpredictable. In the modern financial world, most of what we consider wealth is actually just a digital entry on a ledger controlled by a bank or a government. This works well during times of peace and cooperation, but it creates a massive vulnerability when international tensions rise. We have seen how global finance can be weaponized, with foreign reserves being frozen or restricted at the click of a button. For a central bank, this makes digital assets a liability that requires the permission of a rival nation to use. Gold is the only major financial asset that exists outside of this digital ledger system and carries no political baggage. It is a neutral asset that does not belong to any specific country and is accepted as payment by almost every nation on Earth. This neutrality is the primary reason why institutions are willing to pay record prices to secure physical bars. They are buying the ability to act independently of the global banking system if the traditional rails are ever blocked. Physical metal allows for the settlement of trade and the movement of value without the need for a third party intermediary to approve the transaction. It is the ultimate insurance policy for a nation that wants to maintain its sovereignty in a polarized world. But the need for this neutral asset becomes even more apparent when we look at how physical trade routes are being disrupted today. This creates a situation where having the asset in your hand is the only thing that truly matters. Now, real quick, make sure to subscribe for more gold videos and hit that notification bell so you never miss a new video. Now, let's keep going. Recent events in major shipping lanes have shown how quickly the global movement of goods can be thrown into chaos. When oil tankers are forced to reverse course or avoid certain regions, it highlights the fragility of our interconnected world. For central banks, these disruptions serve as a reminder that paper promises are only as good as the infrastructure that supports them. When supply chains fail, the priority shifts from digital efficiency back to tangible wealth that can be accessed immediately. This is known as the flight to in hand assets, where institutions prioritize physical possession over any form of credit or debt. If a nation cannot move its currency or access its foreign accounts, it needs a physical tool to settle debts and purchase essential resources like energy. Gold serves as the ultimate settlement tool because it has universal value that does not depend on a functioning internet or a peaceful shipping lane. It can be used to pay for oil or food when traditional currency markets become too volatile to function. The shift from paper wealth to physical metal is a direct response to the increasing risks found in global trade and logistics. Central banks are not just buying gold, they are buying the certainty that they can still operate even if the world stops moving smoothly. This trend toward physical security is much larger than most people realize because a lot of it is happening behind closed doors. But a major disclosure from one of the world's largest banks recently shed light on how deep this trend actually goes. One of the most significant revelations in the gold market involves the massive gap between reported reserves and actual holdings. Reports from major financial institutions suggest that some global powers are accumulating gold at 5 times the rate they officially disclose. This hidden accumulation creates a permanent supply squeeze that the average investor rarely sees in the daily headlines. By underreporting their purchases, these nations can continue to buy large amounts of metal without causing a sudden spike in the market price. Central banks have a strategic advantage in keeping their buying activities quiet for as long as possible. If the public knew exactly how much gold was being taken off the market, the price would likely move much higher and much faster. This shadow buying removes physical bars from the global supply and places them into deep storage vaults where they are unlikely to ever be sold again. This effectively shrinks the amount of gold available for everyone else, creating a long-term upward pressure on the price. The discrepancy between the official data and the actual physical flows of metal is a clear sign of a coordinated effort to move away from paper assets. While the world focuses on the daily price fluctuations, these major powers are quietly building a massive base of hard wealth. This strategy is particularly evident when we look at how the world's second largest economy is preparing for a new financial reality. Their blueprint for gold dominance is changing the way we think about national reserves and global trade. For decades, the global financial system has been built on the foundation of government debt and paper promises. However, we are now seeing a major shift as leading economies begin to decouple from this debt-based system. Instead of holding the bonds of other nations, these powers are aggressively moving their reserves into physical gold. This is not a short-term trade, but a long-term strategy to build a financial foundation that is backed by hard assets rather than just credit. By building a massive gold reserve, a nation can create its own trade network that operates independently of traditional currency risks. They can facilitate trade with partners who are also looking to avoid the vulnerabilities of the current fiat system. This creates a parallel economy where gold is the primary medium of exchange for large scale international transactions. The trust that used to be placed in digital currency reserves is being transferred back to the timeless security of vaulted physical metal. This transition marks the end of an era where paper wealth was considered the safest place to store a nation's future. The move toward physical gold is a recognition that true power comes from owning assets that cannot be printed or deleted by a central authority. But to understand why this is so important for the individual, we have to look at the hidden risks found in almost every other type of investment. This brings us to a concept that most people ignore until it is far too late to react. Most people believe they own their investments, but in reality, they often only own a legal claim to an asset held by someone else. This is known as counterparty risk, which is the danger that the institution on the other side of your contract will fail to deliver. Almost every modern financial asset, from stocks to bank deposits, is actually someone else's liability. Your wealth depends entirely on their ability and willingness to pay you back when the time comes. This risk is especially prevalent in the gold market through products like digital gold accounts. While these paper gold investments are convenient to trade, the investor does not usually have a direct claim on the physical metal. If the institution managing the fund faces a crisis, the investor may find that their paper claim is worth far less than the actual metal it represents. This is why central banks are so focused on owning the physical bars directly rather than through a financial intermediary. Gold is unique because it is the only major financial asset in the world that is not someone else's promise to pay. It has no debt attached to it and does not require a counterparty to maintain its value. When you own physical gold, you are holding an asset that exists independently of the banking system and the legal structures that govern it. But the difference between a legal claim and physical possession becomes a critical distinction when the system starts to show signs of stress. There is a clear hierarchy of ownership when it comes to gold, and not all forms are created equal. At the bottom are speculative futures contracts and digital tokens, which are essentially just bets on the price movement. In the middle are vaulted accounts where the metal is held by a third party on your behalf. At the very top is physical bullion that you hold in your own possession or in a private, non bank vault. The importance of this hierarchy becomes obvious during a systemic event such as a banking holiday or a sudden loss of liquidity. During these events, access to paper based assets can be frozen or restricted for weeks or even months. Investors who rely on the digital system to access their wealth may find themselves locked out exactly when they need their assets the most. Physical owners, on the other hand, remain protected because their wealth is not tied to the functioning of a digital network. Many gold contracts also contain a clause known as force majeure, which allows the provider to settle the contract in cash instead of metal. This means that if the price of gold moves quickly, you might be handed a check for the old price rather than the metal you thought you owned. This fine print is one of the reasons why the world's most sophisticated investors are moving toward direct ownership. This realization is what leads to a personal strategy that mirrors the actions of the world's most powerful banks. Most individual investors focus on short term gains and market timing, but central banks think in terms of decades and generations. They operate like sovereign wealth funds, where the goal is to ensure the survival of the nation's wealth regardless of what happens in the markets. You can apply this same blueprint to your own portfolio by shifting your perspective toward preservation. This starts with creating a personal reserve of assets that carry zero debt and zero counterparty risk. A strategic allocation into physical gold is not about trying to get rich quickly or predicting the next market move. Instead, it is about building a foundation of no debt assets that can weather any financial storm. This part of your wealth should be viewed as a permanent reserve that stays with you through every economic cycle. It provides the peace of mind that comes from knowing you have a portion of your net worth that is completely independent of the traditional financial system. In this context, gold is not really an investment at all, but rather a form of systemic insurance. It is the asset that pays out when the paper based world fails to deliver on its promises. Just like an insurance policy, the goal is to have it in place before you actually need it. But the question many people struggle with is exactly how much of their wealth should be moved into this type of safety. The answer can be found by looking at the specific benchmarks used by the world's most successful institutions. Many of the most sophisticated financial institutions in the world aim for a double digit allocation in hard assets as a baseline for their portfolios. A 10% allocation to physical gold is often considered the standard benchmark for providing meaningful protection without sacrificing growth in other areas. This amount is enough to provide a significant cushion during a currency reset or a major market downturn. However, this percentage is not a fixed number and should be adjusted based on the level of risk you see in the global economy. As global debt levels continue to rise and geopolitical tensions become more frequent, many experts suggest increasing this allocation. The more unstable the financial system appears, the more important it becomes to have a larger percentage of your wealth in no debt assets. Gold acts as the foundation of your financial house, providing the stability that allows you to take calculated risks with the rest of your investments. It is the part of your portfolio that you never have to worry about or check every single day. By keeping a consistent portion of your wealth in gold, you are effectively creating your own private central bank. This provides a level of security that paper assets simply cannot match, especially in an environment where inflation is a constant threat. But to truly understand the value of this strategy, you have to look past the dollar price and see what gold actually represents. This requires a shift in how we measure wealth and the purchasing power of our savings over the long term. It is easy to get distracted by the rising dollar price of gold, but the metal itself does not actually change. An ounce of gold today is the same as an ounce of gold was 100 years ago. What is changing is the value of the currency used to buy it. If you look at the price of gold compared to the cost of essential goods like housing or energy, you will see that gold's purchasing power remains remarkably stable. This is known as the gold constant principle, which shows that gold maintains its value while currencies lose theirs. When gold hits an all time high, it is simply reflecting the fact that the currency has reached an all time low in terms of its real value. If the price of everything else is also rising, then gold is doing exactly what it is supposed to do by protecting your ability to buy those things in the future. This is why successful long term investors stop measuring their wealth in dollars and start measuring it in the weight of the physical assets they own. They know that a certain number of ounces will always provide for their needs, regardless of what the exchange rate says. Thinking in ounces rather than dollars helps you avoid the emotional trap of feeling like you missed out when the price goes up. If your goal is to accumulate a specific weight of metal, then the daily price becomes less important than the act of steady accumulation. This mindset shift is the key to surviving a high price environment without falling victim to fear or hesitation. It leads to the final realization that what looks like a peak today might actually be the ground floor of a much larger move. The history of modern finance shows that record breaking prices are often just the beginning of a new phase of growth. When gold moves past a major level like $4,000, it establishes a new psychological and structural baseline for the entire market. What looks like an all time high today will likely be viewed as a bargain in the years to come as currency devaluation continues to accelerate. Central banks understand this, which is why they are not waiting for a return to the prices of the past. These institutions are buying because they recognize that gold is the ultimate safe haven for sovereignty, security, and wealth preservation. They are moving away from a debt based system that is becoming increasingly fragile and toward an asset that has stood the test of time. For the individual investor, the biggest risk is not buying at the top, but being left with nothing but paper when the system undergoes a major reset. Waiting for a lower price that may never come is a gamble that most people simply cannot afford to take. The institutional buy zone is a clear signal that the world's most powerful players are preparing for a future where hard assets are the only things that matter. By following their blueprint, you can secure your own financial future and build a reserve that is beyond the reach of any government or bank. The path to long term security is not found in chasing the latest trend, but in owning the one asset that has never failed to protect its holders. At the end of the day, central banks buy gold at record highs because they know that true value isn't measured in paper, but in the weight of what you can hold. We'll see you in the next one.